What's up, everybody? It's Rana. Today, we are diving deep into the world of capital budgeting. This is essential whether you're running a Fortune 500 company or managing personal finances. We'll break down complex concepts into bite-sized pieces. In this video, we'll cover what capital budgeting is, why it's important, and the techniques and factors you need to consider. By the end, you'll understand how to make informed investment decisions for long-term financial success. So, what exactly is capital budgeting? It's the process companies use for decision-making on capital projects with a life of a year or more. Imagine you're a business owner thinking about investing in new equipment that costs a significant amount of money. This equipment is expected to last for several years and generate more revenue. You wouldn't just buy the first one you see. You'd analyze whether it's worth the investment. Capital budgeting helps you evaluate the potential return on your investment and determine if it aligns with your financial goals. Think of it as a roadmap for making big financial decisions. It involves analyzing different investment options, forecasting future cash flows, and using specific techniques to decide which projects are worth pursuing. This process considers the time value of money, meaning $1 today is worth more than $1 tomorrow. Even individual investors can benefit from understanding capital budgeting principles for decisions like buying a rental property or investing in the stock market. By evaluating potential risks and rewards, you can make informed choices for long-term financial success. Now, let's talk about why capital budgeting is crucial for long-term success. Imagine building a house without a solid foundation and blueprint. It would be chaotic and costly. That's what happens when businesses don't prioritize capital budgeting. It's the foundation for making strategic investment decisions that impact your business for years. Without it, you risk wasting resources on projects that don't generate sufficient returns. Capital budgeting forces you to think long-term, beyond immediate profits. It plays a vital role in resource allocation, helping you prioritize projects that align with your business goals. This ensures you're making the most of limited resources and investing in areas that drive growth and profitability. By implementing a robust capital budgeting process, businesses can make informed decisions, mitigate risks, and increase their chances of long-term success. It's about being strategic with your investments and ensuring every dollar works towards achieving your financial goals. Let's dive into the key techniques used to evaluate potential investments. These techniques provide a framework for comparing different projects and determining their financial viability. One widely used technique is net present value, NPV, which calculates the present value of future cash flows generated by a project, discounted back to today's dollars. A positive NPV indicates a good investment, while a negative one suggests it's not worthwhile. Another important technique is the internal rate of return, IRR, which calculates the discount rate at which the NPV of a project equals 0. If the IRR is higher than your minimum acceptable rate of return, the project is considered acceptable. The payback period measures how long it takes for an investment to generate enough cash flow to cover the initial cost. The shorter the payback period, the less risky the investment. The Profitability Index PI measures the ratio of the present value of future cash flows to the initial investment. A PI greater than 1 indicates profitability. The discounted payback period is similar to the regular payback period, but considers the time value of money. Each technique has its strengths and weaknesses, and the best approach depends on the specific circumstances of the investment and the company's financial goals. Now that we've covered key techniques, let's walk through the typical steps in the capital budgeting process. The first step is generating ideas, identifying potential investment opportunities that align with your business objectives. This could be anything from expanding into a new market to upgrading equipment. Once you have a list of potential projects, the next step is to analyze individual proposals. Gather all relevant information about each project, including the initial investment cost, expected cash flows, and lifespan. Use the capital budgeting techniques to evaluate the financial viability of each project. After analyzing each project, plan the capital budget by deciding which projects to include based on financial constraints and strategic priorities. Prioritize projects that offer the highest potential returns while staying within budget limitations. Once the budget is set, monitor and post-audit the investments. Track the actual performance of your investments against projections. Identify any deviations from your plan and make necessary adjustments. By following a structured capital budgeting process, you can make informed decisions, minimize risks, and maximize your chances of achieving financial goals. let's talk about critical factors that can influence your capital budgeting decisions. One crucial factor is the current and projected economic conditions, like interest rates, inflation, and economic growth. Rising interest rates can make financing projects more expensive, while a recession can dampen demand for your products. Another important consideration is your company's overall strategy. Your capital budgeting decisions should align with your long-term business goals. The regulatory environment is another external factor that can impact your decisions. Changes in laws, regulations, and tax policies can affect the profitability of your investments. Technological advancements are constantly changing the business landscape. Consider how technological changes might impact your investments. Market demand is crucial. Conduct thorough market research to assess potential demand for your products or services. By considering these factors, you can make more informed capital budgeting decisions aligned with your business goals. This increases your chances of success. Even with the best intentions, it's easy to make mistakes in capital budgeting. One of the biggest mistakes is overestimating cash flows. It's tempting to be overly optimistic about potential revenue, but base projections on solid market research and historical data. Another common mistake is underestimating expenses. Factor in all potential costs, including operating expenses, maintenance costs, and the cost of capital. Ignoring risks is another common mistake. Conduct thorough risk analysis and develop contingency plans to mitigate potential downsides. Focusing on short-term gains over long-term value is another error. Consider the long-term impact of your investments and align decisions with your overall business strategy. Not having a structured process is a recipe for disaster. A structured process ensures you're considering all relevant factors, evaluating projects consistently, and making informed decisions. By being aware of these common mistakes, you can avoid costly errors and make smarter investment decisions that drive long-term success. Let's look at some real-life examples of capital budgeting in action. First up, Apple. In 2004, they invested heavily in developing the iPhone, a massive capital budgeting decision with significant risks. They carefully evaluated the potential return on investment and considered long-term market trends. This decision paid off and transformed Apple into one of the most valuable companies in the world. Another example is Tesla, investing heavily in research and development, manufacturing capacity, and global expansion. These significant capital investments require careful planning and execution. While Tesla has faced challenges, their commitment to innovation and long-term vision has positioned them as a leader in the electric vehicle market. Amazon is known for strategic capital allocation, investing in e-commerce infrastructure, new markets, and technologies like cloud computing and AI. These investments have allowed them to dominate the e-commerce market and become one of the most innovative companies. These examples show how companies use capital budgeting to make strategic decisions that drive growth and innovation. By studying these examples, you can gain valuable insights to apply to your own investment decisions. Now it's time to answer some of your most pressing questions about capital budgeting. What are some common methods for determining the discount rate to use in capital budgeting? One common method is the weighted average cost of capital, WACC, reflecting the average cost of all financing sources. Another approach is a risk-adjusted discount rate, factoring in specific project risks. How can I incorporate flexibility into my capital budgeting decisions? Build in options analysis to adjust investment decisions as more information becomes available. For example, include an option to abandon a project if it's not meeting expectations. What are some common red flags to watch out for when evaluating a potential investment? Watch out for overly optimistic projections, lack of a solid business plan, inadequate risk assessment, and poor management track record. Conduct thorough due diligence and be wary of any investment that seems too good to be true. How can I align capital budgeting decisions with my overall business strategy? Define your business goals and objectives. Then evaluate each potential investment based on its potential to contribute to those goals. Make sure your capital allocation decisions align with your overall strategic direction. So there you have it, a comprehensive guide to capital budgeting. We've covered everything from the basics to advanced concepts, and hopefully you now feel equipped to make informed investment decisions. Remember, capital budgeting is an ongoing process requiring careful planning, analysis, and monitoring. By understanding key principles, utilizing the right techniques, and avoiding common mistakes, you can make strategic investments that drive long-term success. If you found this video helpful, please give it a thumbs up and share it with your friends and colleagues. Don't forget to subscribe to the channel for more videos on finance, investing, and entrepreneurship.